right, in Chapter 10, we are going to be working with the accounting for long-term assets. One of the first things we need to talk about is when an asset is purchased, property, plant, or equipment, what amount do we record in the asset account? And the general rule is any cost the company incurs to purchase the asset, get it in place and ready for use, those are all capitalized or recorded as part of the asset. If it's a cost incurred to start using the asset or after we've already acquired it, the use of it, that is not recorded as part of the asset. That is just recorded as an expense of the period. Okay. So for example, in this exercise, Rizzio purchased a machine for $12,500. The terms of the purchase were 2% discount if paid in 10, if not the net or full amount is due in 60, FOB shipping point. This is important because this tells us where ownership transfers. Ownership transferred as soon as that machine shipped to us. So we own the machine while it is in shipment. We are responsible for any shipping costs. Shipping costs will become an additional expense in addition to the purchase price of $12,500. We ultimately paid for this purchase within the discount period and took the $250 discount. In other words, we took 2% off of the original purchase price. So the original purchase price was less by $250. The cost to get it shipped to us were $360, which we paid. The machine required mounting and power connections of $895. We paid another $475 to assemble the machine and $40 of materials to get it into operation. During installation, the machine was damaged and $180 worth of repairs were made. What we're trying to determine is when we bought this machine, what costs would we record? All right, well, let's start by talking about the original price, $12,500. That is absolutely a cost of purchasing, getting the asset in place and ready for use. But we ultimately paid $250 less for prompt payment, so our actual purchase price was $12,250. But those weren't the only costs of buying the asset and getting ready for use. We paid for transportation. We paid to mount and power the machine. We had to assemble it. And then any materials we used to get it ready for use, all of those costs were incurred to purchase the asset, get it in place and ready for use. So they are all considered part of the cost of the asset. We include them with the purchase price. We will ultimately be recording $14,020 into the general ledger through a journal entry. Okay, and that journal entry would be to debit machinery for $14,020, and we would credit cash if we had paid cash for it. Actually, we didn't pay cash. We paid on account, so we would have recorded accounts payable. Okay. However, that $180 worth of repairs that we had to make, it is not kind of one of the normal costs of getting the asset in place and ready for use, so it would not be included. We would have ultimately recorded that $180 as a repair expense at the time it was incurred. Okay. The difference, all of these costs are normal costs to get the asset in place and ready for use. This was an operational expense recorded as an expense right away because it wasn't a normal expense to get the asset ready for use. In that previous problem, we differentiated between costs incurred to get the asset ready for use and recorded that in the asset account, as opposed to an expense of operation or trying to get it ready, but it wasn't a normal cost. And the reason we're making that differentiation is because all of the costs that we incurred to buy the asset, get it ready for its use, we don't want to record any of those costs as an expense until we've started to use it. We want to match the expenses of that asset with the accounting period revenues that that asset is helping us earn. That is what this problem is going to have us do. It's going to have us recording depreciation to record part of the asset cost as depreciation expense to match the cost of that asset with the revenues it helped earn. So working with this machine that originally cost the company $257,500, it has a 4-year life and an estimated $20,000 salvage value. It is installed in Luther Company's factory on January 1st. The factory manager estimates the machine will produce 475,000 units of product during its life. It actually produces 220 in year 1, 124.6 in year 2, 121.8 in year 3, and finally in year 4, 15,200. The total number of units produced by the end of year 4 do exceed the original estimate, and we did not predict this difference. Okay, one thing we need to keep in mind, that as we are depreciating this asset, we cannot depreciate it so its book value falls below its estimated salvage value of 20 grand. What they're going to have us do is they're going to have us calculate the amount of depreciation expense to record for each of the assets' 4 years of life and put it into a table or like this, okay? And what this is going to have us doing is just keeping track of the amount of depreciation expense using each of the 3 depreciation methods over the 4 years of the asset's life. Okay. So let's start by working with a straight line method. Okay. And remember, the straight line method is a very simple method that evenly spreads the cost over the asset's years of useful life. In order to do that, we are going to take the original cost of the machine and subtract out its salvage value. That will tell me how much of the asset's cost we will be depreciating. For the straight line method, we are going to take the asset's cost minus its salvage value, or the depreciable cost, divide by the number of years of useful life. This machine is expected to last 4 years. If we divide the depreciable cost by 4 years, we have determined we are going to depreciate $59,375 per year under the straight line method. So in year 1, my adjusting entry would be to debit depreciation expense for $59,375, and I would then credit accumulated depreciation for $59,375. At the end of year 2, I would need to record another year's worth of depreciation. The great thing about the straight line method, I don't have to go back and recalculate. Because if I did, nothing would change. The original cost is still $257,500, salvage value is still $20,000, still expecting 4 years of life out of this thing, still going to record another $59,375 of depreciation for year 2. So the second year's depreciation is going to be the same as the first. The adjusting entry is going to be the same as the first. Same thing would happen in years 3 and 4. Over the course of the 4 years, we would have recorded $237,500 worth of depreciation, bringing the accumulated depreciation balance to $237,500. When I subtract that from the original cost, I would be left with a salvage value, or value in the books of the asset, $20,000 book value. Okay, that means this method ensured that I did not depreciate my asset's value below the salvage value. Salvage value is still $20,000, which equals the book value. Again, depreciation under the straight line method, super easy. Amount is the same year after year, journal entry is the same year after year. But if I'm going to use the units of production method to determine depreciation expense each year, it's going to take 2 steps to do this calculation. My first step is going to determine my depreciation rate per unit. So I'm going to take the asset's cost minus its salvage value And instead of dividing by a measure of life in years, I'm going to divide by a measure of life in units. If I divide the depreciable amount by 475,000 units, my depreciation rate per unit is 50 cents. So step one is done. I now have a depreciation rate per unit. To determine depreciation expense in year one, I am going to multiply the actual units produced, which were 220,000, times my depreciation rate per unit. That gives me the amount of my depreciation expense for year one. So I would debit depreciation expense for 110,000, and I would credit accumulated depreciation for 110,000. When that adjusting entry gets recorded at the end of year one, it will cause the balance of my accumulated depreciation account to go up to 110, causing the book value of my asset. Remember, book value is the difference between the asset's original cost of $257.5 minus its accumulated depreciation balance, leaving me with a book value of $147.5. Using the units of production method for year two, I would multiply year two's actual production, 124.6, by 50 cents, giving me depreciation expense in year two of 62.3. So my adjusting entry in year two would be debit depreciation expense for 62.3, credit accumulated depreciation expense for 62.3. That would cause the balance in my accumulated depreciation account to increase to 172.3. As my accumulated depreciation balance increases, the asset's book value will fall. Cost minus its accumulated depreciation gives me the asset's book value at the end of year two. For the third year of the asset's life, it produced 121.8. Multiply year three's actual production times my depreciation rate per unit. Depreciation expense for year three of 60,900. I would debit depreciation expense for 60,900 and credit accumulated depreciation for 60,900. That will cause my accumulated depreciation balance to increase and my book value would fall. Cost of $257.5 minus my accumulated depreciation, book value of $24.3. Now the one thing we have to watch with this method is we have to be paying close attention in year four, because in year four this thing was used to produce 15,200 units actual production times 50 cents per unit. If I were to record 7,600 worth of depreciation expense, it would cause my accumulated depreciation amount to go too high, resulting in a book value falling below my salvage value. So I have to, in that last year, is ignore the formula for the calculation, and I'm just going to compare my book value when I started year four with the book value I need at the end of year four. And that's going to be how much depreciation expense I'm going to record. So that fourth year, I'm only going to record $4,300 worth of depreciation expense. Doing so will cause my accumulated depreciation account to increase to $237.5, causing my book value, cost minus accumulated depreciation, to fall to $20,000. And remember, we have this asset has a $20,000 salvage value. So I want to make sure the book value is still recorded at what we expect to get out of it, because the asset still has a value of 20. So that's the only trick to this method, is just paying attention to that last year of the asset's life. And finally, we now have come up with the depreciation every year for straight line and units of production. Now let's do the same thing, but let's do it for the double declining balance method. Okay. And again, this is also going to be a two-step process. To get the double declining balance amount, the first thing I need to do is to determine what my depreciation rate per unit will be, or my depreciation rate based off of the book value will be. And to come up with that, I'm going to take the number of years of life and divide it into 100%. That's going to tell me the percentage of the asset that's being depreciated each year under the straight line method. 100% divided by 4 is 25%. So the straight line method is depreciating 25% per year. And the double declining balance method says double it. So we're going to double that 25% to 50%. So the declining balance method is saying every year we are going to record 50% of that asset's book value for depreciation. Year 1, the beginning book value of our asset is $257,500. That's what it was worth in our books when we began this year. Remember, the book value is the difference between the asset's cost of $257,500 and its accumulated depreciation. This was a brand new machine on the 1st of January, which means there was no depreciation accumulated on it yet. So accumulated depreciation was 0 at the beginning of this year. So if I take $257,500 cost and subtract a 0 accumulated depreciation, my book value is $257,500. Multiply that times my depreciation, my double declining balance depreciation rate of 50%, I will record $128,750 worth of depreciation expense for this first year. My journal entry will be to debit depreciation expense for $128,750 and credit accumulated depreciation for $128,750. When that is recorded, my accumulated depreciation account at the end of year 1 will go from 0 up to $128,750, which causes my book value, cost of $257,500 minus accumulated depreciation of $128,750, book value will become $128,750. Last year's beginning, end of year 1 book value becomes the beginning book value for year 2. And when I get to the end of year 2 and I'm trying to determine my depreciation expense, I'm going to multiply my depreciation rate times the year's beginning book value. Beginning book value is $128,750 times 50%. Depreciation for year 2, $64,375. Accumulated depreciation credit $64,375. When that is recorded, it will cause accumulated depreciation to increase to $193,125. My book value will fall from $257,500 minus $193,125. It falls to $64,375. Year 2's ending book value becomes year 3's beginning. End of year 3, when I'm determining depreciation expense, I take the beginning year book value, multiply it times 50%. Depreciation expense for year 3 will be $32,188, rounding up. debit depreciation expense for $32,188, credit accumulated depreciation for $32,188. When that is recorded, it causes my accumulated depreciation to increase, and my book value cost minus accumulated depreciation falls to $32,187. Finally, in year 4, we began the year with a book value of $32,187. But remember, we do not want to record so much depreciation that last year of asset's life that would cause its book value to fall below salvage value. Just like with the units of production method, we have to watch that last year very carefully. Because if I just multiply 32,187 times the 50% depreciation rate, I would record 16,000 in depreciation expense. That would cause my accumulated depreciation to go up a little bit too high, causing the book value to fall below 20. So just like in the units of production method, when we get to the last year in the declining balance method, ignore the formula. Just compare what the current book value is to what we want the book value to be. We want the book value to go from 32,187 to 20,000, which means we need to record $12,187 worth of depreciation expense by debiting depreciation expense and crediting accumulated depreciation. When that is recorded, accumulated depreciation goes up to $237,500, causing my book value to fall to $20,000. So now that we have our depreciation expense for each of the 3 methods, notice that all of these methods result in the same amount of depreciation expense being recorded over the asset's life. The only difference is the timing of when it is recorded. Okay, straight line is even over the asset's life. Units of production varies depending on how much the asset is used each year. And the declining balance method records the most depreciation expense early on, and it declines over the asset's life. We have now looked at the accounting for the cost of a long-term asset when it's acquired, how we deal with that. We have looked at how we spread that cost over the asset's life, recording it as an expense using 3 different methods. Now let's talk about what happens when we get to the end of an asset's life and we're done with it and we're getting rid of it. We're disposing of it. So this problem is looking at the disposal of plant assets. Onslow Company purchased a machine for $178,000 cash on January 2nd. On January 3rd, they paid $28.40 to wire electricity to the machine. Onslow paid an additional $1,160 on January 4th to secure the machine for operation. The machine will be used for 6 years and has a salvage value of $14,000. They will be using the straight line depreciation method to record depreciation expense. On December 31st, at the end of the 5th year of operations, it is disposed of. So we're going to prepare journal entries initially to record the machine's purchase and the cost to ready it for use. Cash is paid for all costs incurred. Remember that very first problem. We record the machine at its original cost, and we also include in the asset account any cost to get the asset in place and ready for use, normal cost of doing so. So on January 2nd, we paid cash for the machine, recorded in the asset account. After we paid cash for it, we paid $28.40 to wire electricity. So on January 3rd, we have an additional cost. We've the cost of that asset, getting it in place and ready for use, it's increasing. So we're going to increase the machinery asset account again with a debit and credit cash. And another day later, we had to pay another $11.60 to get it secured, to get it in place, I guess bolted to the floor, secured for operation. Again, that is another cost of getting that asset ready for use. So again, that gets recorded in the asset account. All costs associated with purchasing the asset and normal costs to get it in place and ready for use, all recorded as part of the asset's cost. Those will not become an expense until we start using it and that machine is helping us generate revenues. That's when we're going to be recording a little bit of that cost as depreciation expense over its life. So now that we've got the journal entries to record the purchase of the machine, get it ready for use, now let's prepare journal entries to record depreciation at the end of its first year and the year of its disposal. They are using the straight line method. And remember, the straight line method takes the asset's cost, the amount recorded in the asset account, subtract out its salvage value, and then divides by its years of life, 6 years. All right, so let's talk about the asset's cost. $178,000 was put in the asset account, plus another $2,840, plus another $1,160. Total cost recorded in the asset account, I did the math wrong, let me redo that, 178 plus 2,840 plus 1,160, 182,000. Total asset cost in the asset account, 182. I am going to subtract the 182, subtract out the salvage value, and divide by the number of years of life. So 182 minus 14,000 divided by 6, straight line depreciation is $28,000 per year. So I will debit depreciation expense and credit accumulated depreciation for year 1. This same entry would be recorded in year 1, 2, 3, 4, and 5. Here is the first year's entry, and then in the 5th year, the entry would be exactly the same. So think about this. We would have done this in year 1, year 2, year 3. We would have done this for 5 years. We would have resulted in 5 years worth of depreciation on this machine, which means when we get to the end of the assets last year, we will have $140,000 worth of depreciation recorded on it and kept track of in the accumulated depreciation account. So now when we go to sell it or dispose of it at the end of that 5th year, the book value of that asset is the difference between its original asset cost of 182 minus its accumulated depreciation of 140. It has a book value of 42,000. When we go to get rid of it, let's assume we sell it for $15,000 in cash. Well, let's think through the journal entry here. We are selling it for 15 grand in cash. We are going to debit cash for 15 because that's the amount of cash we're receiving. We are getting that cash because we are selling this machine. If we are selling this asset, we do not want to have any trace of it. We don't need any amounts recorded in the ledger for an asset we no longer own. The 2 accounts that have an amount related to this asset is the asset account itself, machinery. So we need to decrease the machinery account, getting rid of that entire asset value. We are going to decrease accumulated depreciation. Don't want depreciation on an asset we no longer own. If we stop and think about what's happened here, we have an asset that is worth $42,000 in our general ledger, has a $42,000 book value. We are selling it for $15,000 in cash. We are taking a loss on this sale. Losses are just like expenses. They both cause our income to go down. They both have debit balances. So to record a loss, I'm going to record it just like in an expense. Debit it to increase it. The only difference between expenses and losses, expenses are part of the normal cost of running the business. Salaries expense, rent expense, utilities expense. Whereas selling a machinery for less than what it's worth to us, that's not a normal part of our operations. We're not normally selling our assets off, right? This is just kind of a once every now and then type thing. So we don't call it an expense of the sale, we call it a loss on the sale of machinery. But again, it's just like an expense. They both have debit balances. They both are recorded and reported on the income statement, and they both cause our income to decrease. What if instead of only selling it for 15, what if we sold this thing for 50? Going through that same thought process. We are selling it for 50. We are receiving cash of 50,000. We're getting cash because we sold off this asset, so we want to erase it out of the general ledger. So we're going to remove the amount from the asset machinery account with a credit. We are going to decrease the depreciation accumulated on it out of its accumulated depreciation account with a debit. We sold an asset that was worth in our general ledger $42,000. We sold it for $50,000. We have an $8,000 gain. So we are going to record a gain. We had a little bit of a profit on the sale of this machinery. It's adding to the company's overall profitability. Gains are just like revenues. They both have credit balances, and the bigger those accounts become, the more they cause our profits to go up. Gains we differentiate from revenues because revenues are increases to our profits from normal type of operations, selling to customers, providing a service, selling an inventory. Whereas gains are increases to our profits that are not part of our normal day-to-day operations. Right? We don't normally sell off our assets for a profit. We just do it once in a while. So a gain and a revenue are basically the same type of an account, but we just differentiate increases to our profits from normal sales to customers. We differentiate that from a little bit of an increase to our profit from selling off one of our assets. Okay, but again, this increase to this account with a credit balance, it will be reported along with our revenues in our income statement, showing a little bit of an increase to our profits. Okay. All right, hopefully this helps with the concepts in this chapter. Let me know if you need any help.